In today's video, we're looking at some of the best brokerage bonuses for 2026. Whether you're just starting your investing journey or you already have money in the market, there's a ton of compelling offers. We'll start with the bonus-focused ones, then some long-term ones, and then some very long-term ones. Also, these are accurate as of filming, but bonuses can and do change. If you want to run the analysis for any of these, I'll leave links to calculators down below, that way you can play with numbers, especially because some of these can be a bit weird or complicated. The three key parts we're looking at are the raw returns, annualized returns, and then also fees for transferring in and out. There is an entire meta here as well that we'll cover towards the end since it is a pretty big rabbit hole. Also, for the most part, I'm going to focus on the brokerage ones. There are ones that are IRA only and other ones that are cash only. For example, Moomoo has a deposit bonus, but securities transferred via ACH or ACATS are not eligible. They might still be good, but for me, I'm trying to shuffle my ETFs around and just get bonuses from them. For these large transfers, we're going to be using ACATS, which is automated customer account transfer services, which allows you to move your financial assets like stocks, bonds, mutual funds between brokerages. The main draw being that you can do this without selling any assets, meaning that you avoid taxable events. The rationale being that for the larger bonuses, where you have to have a lot of money, you don't want a taxable event because that doesn't make sense, especially if these are long-term hold positions anyways, and you might already have significant gains. Also, there can be fees for transfers, but also tricks. For example, when you transfer money out of Schwab to another brokerage, they'll charge you $50 for a full ACATS, but $0 for a partial one. A very common strategy being to transfer everything and leave maybe $1 or $5 so that it's partial to avoid the fee. Some will also reimburse fees from your old brokerage when you're transferring in, so it gets pretty interesting. Okay, so with all of that said, we're going to start off with Schwab and E-Trade, which are the 12-month ones, then some fast 3-month ones from Merrill Lynch, Citi Wealth Management, and Ally Invest, and then a weird 9-month one of TradeStation, 3-year long-term one of Betterment, and 5 years of Public and SoFi, and then some more unique, super long-term potentially ones with Plynk and Silo. For a lot of these, it's not either or, it's like an intro bonus for a card for trying something. You do need to have the assets, but otherwise you can get rewarded pretty well. Big favorite before we dive in is to give this a thumbs up to help with the algorithm. If you know someone that might benefit from this, then share this with them. Okay, starting off with the most straightforward with Schwab. They're one of the big 3 retail brokerages alongside Fidelity and Vanguard. They're one of the top brokerages for active traders who want a lot of features. If you're a beginner, then Fidelity might be a bit better, and long-term focus could be Vanguard, and advanced stuff is more interactive brokers. The offers for new customers, and you're looking at $100 for depositing $25K, $300 for $50K, $500 for $100K, and $1,000 for $500K. It is net deposits and it has to be done within 45 days, and you need to maintain that balance for 1 year. A lot of accounts do count for this, including IRAs. If you're transferring investments in, unless you're doing anything weirdly exotic, there's no tax consequences since you're not selling the assets. You could sell them if you want to, but you don't really need to sell them and you generally wouldn't want to. Okay, so what value are we getting here? Doing the math, you're looking at 0.2% to 0.6%, with the sweet spot being $300 for $50K. Not a crazy amount, but consider that the historic long-term average annual nominal return for the S&P 500 is about 10%, 0.5, 0.6 isn't bad. Also, even though there isn't any tax consequences for moving money around, there are tax consequences for the bonus. Depending on brokerage, you're generally looking at a 1099 miss or a 1099 interest form. When you transfer money in from another brokerage to Schwab, Schwab doesn't charge you a fee there, but the other brokerage can for leaving. Schwab often will do reimbursements between $50 and $100, but it is on a case-by-case basis. Looking at some data points, even $10,000 can qualify for the reimbursements for the ACAT fees, so not too bad at all. If you decide to leave Schwab after a year, the full outgoing fee is $50, but you can also do a partial one, and that's $0. One strategy a lot of people do is they transfer everything, but leave $1 or $5 in the account, that way it's a partial transfer. If you have a Schwab checking account, then just transfer the remaining cash balance afterwards to close it off. Also, Schwab doesn't charge a fee for keeping it open, so that could also be fine. Okay, next annual one is E-Trade from Morgan Stanley. They have both a brokerage one and an IRA one. Starting with the brokerage one, deposit amounts range from $1,000 to $5 million, and the cash credit is $50 to $10,000. Some of these do get pretty aggressive and why asset transfers make more sense. This one is a 12-month hold, so not too bad at all. And then looking at the numbers and the percentages, it starts at 5%, but drops pretty aggressively. So the top $10,000 number is 0.2%. You'll see this with the other ones as well, but the sweet spot for me is about 0.4%. So the $1,000 for $200K makes sense. After that, it becomes a bit tougher. I would consider 0.4 per year to be the target. One obvious consideration is if you did have this much money, would you care about the bonuses at all? I think it just depends on you and your circumstances. So if you're fat fire and you're retired, an extra 10K doesn't really hurt for moving your ETFs around. And to be fair, your mileage may vary depending on if it's worth your time. If you're a business owner or startup founder who has a lot of other things going on, then probably not. The idea being that you can make more money elsewhere and probably a lot faster. On the other hand, if you're fat fire and retired, or you work a very cushy job where you don't really have to work that hard, then it's not a bad little side quest. Again, you're not forgoing any market returns here since you have the same investments, but you're just moving it from one brokerage to another one. If anything, most people that are moving stuff around are just moving around their VOO, SPY, VTI, or VT. I probably wouldn't move around stuff that you're frequently trading. They also have a retirement offer that's the same, but a little bit different. All the deposits and cash credits are exactly the same, so nothing different here, and they just do different account types, including IRAs. In terms of reimbursements, E-Trade doesn't have a standard program, and the rationale that they have is that you're getting a new bonus, so they shouldn't need to reimburse you. If you are leaving them, it's a $25 fee for partial transfers and $75 for a full account transfer. Also, there are data points of them waiving the transfer fee if you maintain a balance of over 5K. So that technically could be 5K in cash. Bulge bracket banks have similar offers, but with shorter windows. For example, let's look at Bank of America, Merrill Lynch. This one's for brokerages and not IRAs. Here they're offering $100 for 20K, $200 for 50K, $400 for 100, and $1,000 for 250K. As raw numbers, it's a pretty good range, 0.4 to 0.5, which is solid. The main difference is that for a lot of these, the assets only need to be in there for 90 days, so 3 months of a 12-month year. That means that you're getting similar value as the last two, but for a significantly shorter period. In order to compare apples to apples, we want to annualize this, and here we would times it by 4. The rationale is that if you're min-maxing, you'd be done with the bonus, and you can move it somewhere else. You could theoretically hit 3 or 4 different places and get rewarded 3 or 4 different times. It doesn't have to sit there for a whole year like Schwab. Okay, so annualizing the numbers, you're looking at 1.6 to 2%, which is pretty crazy. The argument against annualizing is if you don't plan to move stuff around, then maybe it doesn't work, but still you want to compare apples to apples. The main idea is that you technically have the option if you want it. In terms of reimbursements, Merrill Lynch doesn't reimburse incoming ACAT fees, so you're out of luck there. For outgoing, partial is 0, and then full is 50 for brokerages. Here you'd want to do partial, leave some money, and then transfer it into your Bank of America account, or even if you leave $1 and let it go, that's fine. Next up, we have Citi Wealth Management. They have a lot of options ranging from 50K to 2 million. 50K get to 500, 200K get to 1,000, 500K get to 2,000, 1 million get to 3,000, and 2 million, 5,000. For the raw numbers, you're looking at 0.25 to 1%. These are funds that are new to Citi, so it could be from Merrill Lynch. You have a 90-day hold period. If we annualize everything, then you're looking at 1% and 4%, and I would say that the 2 and 4% look pretty good. Also a reminder that offers can change, and with big banks, they often do get extended, and you tend to see them every year. For reimbursements, it's on a case-by-case basis and at the discretion, and probably depends on your account balance. For transferring out, Citi doesn't charge a fee for partial ones, and then full transfers are $95. Next up, we have a really good one, which is Ally Invest. There is a catch though. So it's only available for active Ally Bank or Ally Auto customers who haven't already previously had an account with Ally Invest. It's also on the smaller end, so you're getting 100 or 200 depending on where you're moving money in from. For the 100, it's 1,000 from an Ally Bank account, and for the 200, it has to be from a non-Ally account. If you only have one shot, I'd probably go for the 200. The holding period here is only 90 days, meaning that you have a very good return here. You're looking at 10 to 20% raw, and then annualized, that's 40 to 80%. Again, $200 for $1,000 for 3 months is pretty solid. Even though it can be securities, I'd probably just do cash even from an external account since it's such a low number. Oh, also IRAs are not eligible for this promotion. If you do want to transfer in securities, they do reimburse up to $75 for ACAT fees, but you do need to transfer in $2,500 or more. Transferring out of Ally does have a fee though. Whether you do a full or partial transfer, you're looking at $50, meaning that you'd probably want to do a full transfer. On a side note, if you are looking for any brokerage bonuses and you want to support the channel, we have links on the website, AskSebby.com/investing, and also down below. Make sure they're competitive and that it makes sense for you, but otherwise it's a huge way to support the channel, so thank you in advance. Next up, we have TradeStation. There's 6 offers here. 150 for 5K, 300 for 25K, 500 for 100, 1,000 for 250, 2,000 for 500K, and 3,500 for a million. If we map everything out, it starts at 3%, then 1.2, and then drops all the way to 0.35. IRAs don't count for this one, but cash and securities and other brokerages are fine. This one has an interesting window. So you're looking at 270 days, arguably 3/4 of a year. If we annualize everything in a simple way, you're looking at 4% down to 0.47%, which isn't as good, but still is above my hurdle rate of 0.4. Not a bad offer at all because it's not that committal. One downside is that they don't offer any reimbursement fees for any incoming transfers, and they also have some of the more aggressive outgoing fees. So for the full transfer out, it's $125, and they don't actually have a separate amount for partial ones, so you're still paying the $125. And even if you do try to get a fee waiver with them, they oftentimes tell you to kick rocks. There also are some offers with significantly longer hold periods. For example, let's look at Betterment, and a lot of terms here, but you're looking at a 3-year holding period. For deposits, you're looking at between $2,500 to $200K, and bonus is $100 to $1,500 in value. Note that these are total rewards and not per year. So even though the raw numbers look pretty good, 4% to 0.75%, once we annualize it for the fact that you have to keep it there for 3 years, it's 1.33% down to 0.25. Given my target of 0.4, only the top two would make sense. The bottom ones are not that competitive. Not bad if you want something simple, but there's better offers. Also, this is for standard brokerages and IRAs, so quite a bit of flexibility here. They don't do any reimbursements for transfers in, and transfers out get a little interesting. They charge $75 for each account with them, and you can have multiple because each goal is a separate account. So for example, you might have a general investing one, a safety net one, and a retirement one. That would be 3 accounts and $225 in fees. Also, they do charge this with any partial or full transfer, so there's not really any way around this. So if you are looking to try Betterment and you're not sure if you're sticking around, then I probably wouldn't set too many different goals. There also is an entire meta with fees and how you want to get them reimbursed, so which one you want to go to when. I'll put a full chart towards the end, but it is a bit weird. Okay, so the next batch are percentage-based and a function of your deposit rather than having a chart. Otherwise, they still work pretty much the same. The first one's public, which looks very good on the surface, and they're offering a 1% match on eligible transfers, including brokerages and IRAs. The main issue, though, is a 5-year holding period. So 1% raw divided by 5 years is 0.2% annualized. Not bad, but nothing crazy and very committal. 5 years is a very long time, especially if there's better bonuses. They do reimburse up to $100 in ACAT fees if your transferred balance is $5,000 or more. For transfers out, they charge a $100 fee, whether full or partial. Also, if you do have fractional assets or crypto with them, then they would have to liquidate it first because they can't transfer those. Another similar one is SoFi. So 1% unlimited match for brokerages or IRAs, and it is a 5-year hold, which is quite a bit. 1% divided by 5 years is 0.2% annualized. The reason why you don't want to rush into these ones is that there might be better offers, even from themselves. For example, earlier in the year, SoFi had a 2% transfer bonus that ended May 28th, 2026. That one was a 5-year holding period, but limited to $5 million. $5 million times 2% is $100K, so that's a $50,000 difference for the limited time offer. 2% raw divided by 5 years is 0.4% annualized, so worth chasing. They also do reimburse fees up to $75 if you transfer in 5K or more, and then when you are transferring it out, it's $100. That 100 is whether you do full or a partial transfer. There's also 2 long-term ones that have a bit more flexibility, meaning you can leave if you need to. Also very unique in how they work. The first one's Plynk, and then the second one is Silo. I'm probably going to call the video Best Brokerage Bonuses of 2026, but if that doesn't do well, I might call it Plynk versus Silo. The rationale being that those are the 2 interesting ones with unique features. Starting with Plynk, they do work with Fidelity, and it's under that umbrella. Their offer is brokerage only and pretty unique. They offer 25% of cash on the dividends paid on eligible securities that are held in your brokerage. Lots of terms here, so feel free to pause, but eligible securities include common stock or ETFs or mutual funds. They're giving you 25% of the dividends paid out up to $250. Doing the math, $250 divided by 25% is $1,000 in dividends, and that's our target. The next part's where it gets messy because getting that 1,000 in dividends varies depending on your securities. One of the gold standards is the Schwab US Dividend Equity ETF, SCHD. The reason being that it balances the baseline yield with dividend growth. Right now, it's about $32 a share and it pays out about $1, so that's 3.3% yield. Our goal is 1,000 in dividends to get that 25% for $250, so 1,000 divided by 3.3 is a $30,300 position. It's definitely not a small number, but an extra $250 doesn't hurt. 250 divided by 30K is 0.825% as an extra yield. Or I guess another way to put it is you take the 3.3% yield that you're getting and times that by 1.25x, so 4.125 total. It doesn't sound like a big deal, but if you are dividend farming, then an extra 25% doesn't hurt. If you are looking for higher yield and you aren't looking to be as balanced, then there are other options. For example, KBWY from Invesco. Their annual dividend range is 7.87 to 8.28%. Another one is JEPI, which is at about 8.16%. 8.16 times 25% is an extra 2.04% extra. This also changes the target size pretty dramatically. So we're targeting 1,000 dividends divided by 8.16% means that you're looking at a portfolio of 12,255. Confirming the math, 250 bonus divided by 12.255 is a 2% yield. It very much depends on your stage of life and what you're optimizing for, but an extra 2% is great. In terms of transferring in, they don't offer any reimbursements. And also, if you are transferring out, there's no fees for partial and then 75 for a full one. The caveat for Plynk is that it is more dividend focused. So if you are earlier in your career and focused on equity growth, then it might be less of a fit. The other interesting one is Silo. This one utilizes interactive brokers. So Plynk, it was under Fidelity, and that's more beginner focused. Here it's IB, which is more advanced and global trader oriented. For this one, you can do brokerages or IRAs. And unlike Plynk, it's less dividend focused. What they do is offer 0.5x points on your entire portfolio. The catch is that there's an annual fee and the math has to work. Here you're getting 0.5x and you're getting up to 50,000 points. So the portfolio that you're targeting is 100K. They also do have up to 225 in credits that we'll get into, but annual fee here is 240. It's not a deal breaker, but you have to run numbers. For example, if your portfolio is only 40,000, then you'd actually lose money. You're only getting 0.5x points, which will be 20K points, and at 1 cent per point, that's 200 in value, minus 240 is negative 40. With that said, there is a sweet spot. The numbers do look better as you go up, and the sweet spot being 100K, where you sit at 260 in net value, which is 500 from the points, minus 240 is 260. As an annualized net number, you're looking at 0.26%, which is fine, but below my target. I guess the argument here, though, is that you don't have to move your money around as much, and you're kind of locked in, but you have the option to move it if necessary. For example, if a very good bonus pops up somewhere else, you're not stuck in a 5-year hold. A big question mark I do have, though, is transfer partners, which are supposed to be coming in July. Depending on the partners, it can either be very great or a non-factor. Worst case, it's still 1 cent per point, and if it is good partners, I'd bump it up to 2 cents per point. The rationale being that you can transfer the points to partners for more value, and some people would argue maybe even 5 or 10 cents, but for me, 2 cents makes sense as a target, it feels fair, and it's within my would pay range for a lot of these flights. So taking the numbers and adjusting for 2 cents per point, then the sweet spot's still 100K, where you get 760 in value, which is 0.76%. If they do add valuable transfer partners, then this is 2 times above my target of 0.4 per year. There also are status benefits, which sound great, but depends on the math. So at 150K, you get a $95 rebate for a credit card annual fee, and at 200K, that's the same 95, and also 130 for a Costco executive membership fee. They do have specific cards listed, but I can't mention it on this channel given some back-end compliance stuff, but it's the grocery store one, if that makes sense. Okay, so if we add these benefits in and we expand a chart from 100K up to 150 and 200K, we see a few different numbers. So again, 100K is 260 in net value, which is 0.26% at 1 cent per point. And then at 150K, it jumps up to 355, which is a bit lower at 0.24%. Same idea, 200K, you're at 485, which is 0.24%. It's not bad, but it is a local maximum rather than the peer maximum of 100K. I think 100K still makes the most sense, but if you do have more than that, then you'd want to be at either 150 or 200 and not at any weird in-between number. Another consideration is that there are additional steps for the reimbursement, and I'm not sure how particular they're going to be with memberships. For example, let's say you have a Sam's Club near you and not a Costco, and you have a Sam's membership, how would that work? Okay, going back to the numbers and assuming that we value things at 2 cents per point, that the transfer partners make sense, 100K is 0.76%, 150K is 0.57, and 200K is 0.49. So it does go down since the benefits are at a cash value, while the points are at a higher value. Technically above the 0.4 target for all 3 of them, but I lean towards 100K. For this level, 100K makes the most sense. With Platinum, you're going to get up to 250K points and 0.5x points on your entire balance, so you're targeting a 500K portfolio. There are up to 1315 credits, and the annual fee here is $960. Taking a look at the numbers, we'll put both the gold and platinum and how they compare. So the 100K mark, gold makes more sense. Same thing with 100K and also 200K. At about 300K, the math changes, where you're looking at 485 value compared to 540, and that's 0.16% compared to 0.18%. Above 300, platinum makes more sense. The sweet spot being 500K, where you get 1,540 in value, which is 0.31%. If you are purely min-maxing and using the 0.26 for the 100K for gold as the target, then platinum makes sense when you're at 400K. The idea being that you're still at that 0.26%. Lots of math here depending on if you're yield seeking and if you have other opportunities elsewhere. If we bump the points up to 2 cents per point, then the math changes by a little bit. At this stage, if you are comparing to 2, then platinum makes more sense at 200K since you're at 0.52%. If you kept it in gold, then it would only be 0.49%. The gold standard though is still the 0.76 with gold at 100K, and if we use that as a mark, it's still 400K of platinum as the target. At 450K, you're at 0.79%, and at 500K, 0.81%, which is 4,040 in value. So if you do have a bigger portfolio, then you'd want to do platinum, but the gold 100K isn't bad either. There also are status benefits here. With 750K, you get the Costco Executive membership and a $325 annual fee card, and at $1 million, Costco Executive, $325 card, and $895 annual fee card. The spreadsheet is a little big right now, so we might be shifting around a little bit. Okay, back to 1 cent per point at 500K, we were at 0.31%, and at 750K, that's 0.27% for the Costco and the mid-level credit card rebate. So technically a little bit worse by the numbers, but I guess not bad. At $1 million, it's 0.29% with Costco, the mid-level, and the flagship card rebates. Even though they are below the 0.31 maximum at 500K, if your money isn't really doing anything else anywhere else, then this could work. For cashback, all of these are below my 0.4% target though. For transfer partners at 2 cents per point, the 500K is the 0.81 that we said earlier, and 750K is 0.6, and 1 million is 0.54. Could still be interesting and I would argue competitive. Reminder that the SoFi offer was 2% divided by 5 years is 0.4 annualized. And SoFi is a bit more locked in, while here you could change your mind next year. With that said, all of this is long-term for Silo. There is an intro bonus. For gold, it's 100K bonus points, so up to 150K points total for the first year. It is 1x on the total transfer up to 100K, so still the same 100K target that we had before. 100K bonus points times 1 cent per point is 1,000 in value, times 2 cents per point is 2,000 in value. So an extra 1,000 or 2,000 on 100K, which is an extra 1 to 2% for that first year. And that's on top of the long-term stuff we calculated. For platinum, it's an extra 250K bonus, and the calculation is a bit complicated here, but the idea is that it's 250K bonus points on a 500K portfolio. 250K times 1 cent is 2,500 times 2 cents is 5,000. 2,500 on a 500K portfolio is an extra 0.5%, and 5,000 on that same portfolio is an extra 1%. Pretty good intro bonus to try for a year. Also, if you are interested, I'll put a referral link down below or go to AskSebby.com/silo. This one is a bit more complicated as well, so I'll also make a calculator if helpful. Compared to a lot of the other offers, I feel like this one is a bit more involved and you need to make sure the math works. For reimbursements, it's up to 100, and for transfers out, whether partial or full, it's 0 fee. Pretty good 1-year test, and you can easily change your mind. There also is an entire meta with transfers, so let's map out a few of them and see what it looks like. Also a reminder that these can change. Feel free to pause, but it's everything we already talked about, and we're looking at a few key things. We're looking for ones that have outgoing transfers of 0 fee for partial, which is ideal, and if not, we would want to link the ones that do have fees with ones that provide reimbursements. For example, I don't know where you're currently at, but let's say you transfer to the Citi Wealth Management one that will often do reimbursements. That's 3 months, and then you could do the partial outgoing transfer to Merrill Lynch. Merrill Lynch doesn't reimburse, but it doesn't matter because you have no fees here, and you use that for 3 months, and if you do outgoing there, partial, it's also 0 fee. Let's say you ACATS over to TradeStation, which doesn't do reimbursements, but it does have an outgoing fee of $125. So after that, you might want to transfer to Schwab, which often does reimbursements as well. And after you finish with Schwab, 0 outgoing, so you can go anywhere you want. Let's say you go to Betterment, which doesn't reimburse, but charges $75 per goal. And after that, maybe you move to Silo. If you try Silo and you don't like it, then there's no fees to move to, let's say, Plynk. Probably a bit confusing, but hopefully it makes sense. The goal is linking $0 outgoing partial ones to the ones that don't reimburse, and then the ones with fees, you'd want to link to ones that do reimburse. And to be fair, the rate probably matters more than the fee, but something to consider. This definitely is a rabbit hole, but it could be 1 to 3 bonuses a year on money you already have in a market that's already invested. Again, if you are looking for brokerage bonuses, check out AskSebby.com/investing, and I'll also link it down below. If you've made it to this point, leave a bag of money emoji in the comments down below, and I'll try to heart it and also respond. 3 questions. Number 1, what are your thoughts on these brokerages? Number 2, do you focus only on credit card stuff, or do you also do bank stuff and brokerage stuff? And number 3, if you are doing the latter, how much value are you getting per year? Let me know and everyone else know in the comments down below. Big favor, thumbs up, share this, but otherwise hope you liked it. See you next time.